History teaches us when transformative technologies come online, they also often face skepticism before becoming foundational to our economy. A century ago, that was electricity. 50 years ago, personal computer. 30 years ago, commercial internet. Each of these technologies matured, though, and policymakers developed legal and regulatory frameworks that gave businesses, investors, and consumers confidence to innovate, invest, and drive widespread adoption. Blockchain technology has now existed for more than 15 years. It's no longer a theoretical concept. It's a practical technology powering real businesses, real networks, and real economic activity. Yet despite its maturity, entrepreneurs and developers are still facing significant uncertainty about how the digital assets are classified and regulated, which brings me to you, Ms. Aberg. Is it fair to say that without blockchain technology, Helium would not exist? In other words, are blockchain and digital assets fundamental to Helium's business model rather than simply being an added feature?
Absolutely. The network would not exist without blockchain. The network operates across 140,000 unique access points deployed by thousands of individuals and small businesses. That's a distributed, decentralized network infrastructure.
No, go ahead. I'll let you finish.
That infrastructure needs to be coordinated between all these discrete points. Blockchain is the technology that allows us to do that.
So knowing that, what's the real world consequences of the lack of clarity in this space from a regulatory standpoint for your business trying to deploy internet and access to consumers across the country?
So the status quo is that there's not a distinction between tokens that operate a functional network like Helium and tokens that are sold as part of an investment contract and for raising capital. We suffered the consequence of that directly on January 17th, 2025. Thankfully, those claims were dismissed. But right now, without codification of that into law, we could face those exact same claims again by under a new administration, new chairman of the SEC.
Thank you very much. I want to jump to you, Mr. Somensatto, and talk DeFi a little bit. Building on a similar theme here, financial markets have grown along technological innovation. 200 years ago, finance relied on handwritten ledgers, horse-drawn or horse-delivered communications. 100 years ago, telegraph and then telephone connected markets. 50 years ago, we got closer to the internet. Today, blockchain technology is giving us an ability to decentralize networks that can coordinate financial activity without a centralized or without a central intermediary. Blockchains enabled that growth and decentralization. So the question comes to you, why is it important that a regulatory framework recognize the unique characteristics of decentralized networks rather than treating them as if they were traditional centralized networks?
Yeah, so I think the fundamental innovation of what we're talking about here is this ability to transact in a peer-to-peer fashion, as you mentioned. And part of that recognition from the regulatory perspective is identifying what are the technology tools here that are being used versus those individuals who are participating in activities that would traditionally trigger registration and regulation. And I think the technology is fairly novel and new in the way that it interacts with financial infrastructure, but it is important to understand that the key innovation here is equivalent to having a tool in place, just like when the markets went from open floors to electronic trading, right? It wasn't the computers and the network wiring that we started regulating, it was the institutions that use those for regulated purposes, and the same is true in this transition.
Thank you very much. I want to jump to you, Mr. Louvar, if I can. Digital assets represents the next chapter. You talked a little bit in your testimony about how you use ETF and ETPs to navigate around some of the roadblocks that are standing in the way. What are those roadblocks? How do we unlock them, and what happens when we do?
Yeah, I look at it from a couple of different angles. First off, digital assets under the umbrella of sort of crypto assets and then tokenization. So let me start off with crypto assets. And so we develop products, exchange-traded products that invest in those assets. So that was our first foray nearly 8 years ago. One of the roadblocks at the time And then fast forwarding was that there wasn't clear delineation of how those assets were categorized. And ultimately, we had an SEC at the time that was really looking at these in terms of not a way under the traditional securities laws and types of disclosure, but more market-based regulation. And so our goal was to launch products investing in those assets at the same time through our U.S. business and through our Europe business. But ultimately what happened is we were able to launch, due to the regulatory environment in the U.S. going back a few years, we were able to launch in Europe many products investing in many digital assets that have now garnered a couple billion in assets where we're way behind in the U.S.
This is our big opportunity, is to put forward a clarity and a regulatory framework so that folks are investing and developing and deploying here in the United States, not in Europe, not in locations around the globe. Cognizant of the time, I'll yield back.